Hello, everyone, and welcome to my YouTube channel. It's a great pleasure for me to have Ted Oakley. He is the founder of Oxbow Advisors, and he is actually one of the people that you can truly call a self made person. How are you, Ted?
I'm great, Daniel. Thanks for having me.
Always a great pleasure. Ted, tell us a little bit about your background because I think it's very interesting, very fascinating, and something that our viewers would learn a lot from.
Well, I think what happens, and I don't think I'm so unusual. I grew up poor as a kid, and had to move around and had to do a lot of things. Had to learn to work very, very early. I started working. I was like 6 years old, so I learned that at a very, very early age. But it helped me, in a lot of ways. And I think what happens is when you come from that type of background, you really, and mine was a background which we really had no money, and I ended up in a situation where today, for example, I learned to give it back too. I have uh, two two of the major foster child foundations in Texas, and it's one of those things where you try to help out if you can because you understand what's going on. It has helped me in this respect. I do think I understand all socioeconomic levels, and that's really important. A lot of people will understand one or the other, but I've lived them all, so I have a fairly decent idea.
That's admirable because it's a great example, and I think that everyone that's watching should check your background. It's in the references below in the details of the video. Um, Ted, I would like to get a little bit about your view about the current state of the U.S. economy. What do you think about the growth and jobs outlook and the general macroeconomic environment? What is your opinion?
Well, for me, Daniel, I think what happens is it's all artificial. I think anybody couldn't argue that point. And when you get into artificial things and all of a sudden they work, then they want to do more artificial things. And that's the problem. And so what I see with it is that you're going to end up in a situation where and I think it'll be a major change for people in this business and in Wall Street because I don't think they're going to be able to understand because of what's happened the last 20 years and then all of a sudden dramatic changes. I could see the economy growing, but the problem is that it's bringing inflation with it. And I think when that happens, because of all the money you push in, and at some point, you have a problem. I'll give you an example. A great book that I read again is called Dying of Money.
Yeah.
There's not many copies. You probably read it yourself, but it's about Weimar Germany, 1918, 1923. For the first year or two, it actually worked quite well. They were buying stocks, everything was going up, real estate. But by the time you got to 23 or 24, it was over. And so I don't know if it happens that way, but I do know I think that will bring that on in time.
Yeah, absolutely. I think that one of the risks that of the level of exuberance and the level of optimism about the recovery is that after a sugar high, you get a sugar low, huh? And that there's you mentioned the word artificial, which is critical, no? Because what we're seeing is that money velocity is not going up, that the labor participation rate remains very, very poor, and that productivity growth has been is extremely weak. So we're forgetting that we need to pump the productive economy, don't we?
Well, that's true. And I think what happens is when you have nothing but financial engineering, which is all we've had for a number of years, you leave the basics of what makes a machine go, the actual real economy. And I think that's what's happened to us. We've basically, if you look at it, our legislatures decided to give it all to the Fed and let them deal with the problem, and the only thing they can do is financial. And so we've left the basics of economics, I think.
Hmm. And when you look at the outlook of inflation, we've heard numerous times from Fed officials that they're not worried about inflation, that it's a base effect driven inflationary pressure, that it's transitory. What are your thoughts about that, and whether that is simply just a typical excuse of people that just don't know what is going on?
Well, Daniel, I've been around longer than most people probably, so good or bad. But uh, the last Fed governor, the last Fed president, really that I believed was Volcker.
Yeah.
That was the last one I believed. After that, I didn't believe him. And so what happens in this one too is I tend to I watch what they say, but I don't use it for anything because I know that as soon as something changes, they'll drop that narrative and go a different direction. I think their biggest problem will be this word they use, tools, where they say, hey, if we start to inflate, we have the tools. But you have to ask yourself the question, what are those tools? And what would you actually do if we inflate with all this debt? So I think that they are probably feel like they've got it all under control, but I don't buy that personally.
Hmm. And with considering that outlook and the rhetoric is always the same. First, you push the limits of monetary policy, say, oh, there's no problem because there's no inflation. You push the limits further, then you say that inflation is transitory, and then when inflation is not transitory, then you blame businesses and you blame the productive economy for raising prices, and you demand price controls. uh, do you fear that?
Well, what I really fear, I would say, is we talk about yield curve control, and if you look at today, I told somebody this last week, they're actually buying long paper now.
Yeah.
You go back in and look at the Fed, the New York Fed every week, and they're buying 10, 20, 30 in a year paper now. So they're in effect, they haven't stated it, but that's effectively what they're doing. And I think what I would probably fear more than anything is that they keep on buying the paper, they keep them artificially low, but in the real world, all of a sudden you're getting this inflation push. And so that's the worst of all worlds, and you're killing the people that are the most conservative.
Yeah, because on the one side, because money creation is never neutral, it disproportionately benefits those that are the first recipients of money, government and the indebted, and hurts the middle class and savers. When you look at that situation, and obviously we as investors have to find the way to navigate situations whether we like them or not. No, how do you think that investors should look at it in terms of positioning?
Well, I think you have to position. I'll just say on our own portfolios, and we run some, maybe three different strategies, four different strategies. But generally, what we look at is what we've made a shift on is we are not 100%, but we're apportioned to a set of commodities, real estate. We've got grains. We've got oil. If you look at metals, we have a portion of that. We have lumber. We have timber, and so we have a portion of that direction. You have to have some of that, I think.
Yeah.
Maybe it's wrong. I don't know that, but I will say this. I think to say that you wouldn't have any was taking a fairly big risk. So we have that. We haven't bought a bond since last July or August, past a year or two. We felt like then that was already going to get for time being, and that's been a good process for us. And now what we're having to do, if somebody walks in the door and they've got really, really conservative money, and you say, okay, well, normally I'd keep you at 36 months or less or something. I mean, very, very bulletproof conservative. You can't do that right now. The
Yeah.
12-month T-bill hit 05 yesterday. I mean, they can't make any money. So you have to make some adjustments to bring in about 20% of that portfolio or so, maybe in some preferreds, some things like that. You have to make some adjustment to try to get it up to where it's at least making some money.
Uh-huh.
On the stock side, we're carrying about 25-30% cash, primarily because we don't have anything that hits the numbers for us.
Yeah, you see that the valuation impact of multiple expansion that we saw in 2020 and continued into 2021 is would be one of the risks that you would categorize in the market right now. How complacent people have become with multiple expansion, or do you think that that is going to continue as long as yields remain that low?
Daniel, I would be surprised if you just look at the history of multiples,
Yeah.
we're right up there. I'm not saying we can't go higher. You can always go higher. But the one thing I've found over, especially the last 3 years or so, and it's really been happening for 10 years, but the Fed has basically created this giant casino, and there's all kinds of tables inside the casino. I can name them all to you, but it's real estate, it's housing, it's stock market, bond market, Bitcoin, you name it. There's a table where you're rolling dice on every table, and they've created that right now. And the problem is you have this whole entire group of people with no memories. In the last 10 or 11 years, there's no bear market for them. So, why worry about it? And then that's where we are today. I just say this, but I've been here before.
Yeah.
So I know that feeling.
That is a very important point, because one of the things that I mentioned a couple of times in the past is that uh, this is probably I think we're going into the third generation of investors, or at least professionals in financial markets that have only seen expansionary monetary policies, and that can only bet on one thing, and that definitely can lead to extreme risk taking. What are in terms of the do you have any particular view about how is that increase in inflation going to translate into the margins of companies? Because one of the debates right now is, okay, as long as they're able to pass that inflation to consumers, it's great to be in the stock market. But what we're seeing, at least for example in Germany and in Japan, is that the producer prices are going, import prices are going up, but they're not able to pass that's crushing margins in an environment in which overcapacity has been kept very much alive because of the massive stimuli. So what are your thoughts about margins here?
Well, I think it's twofold. I think obviously it's cost of goods. The other one probably is going to come into play, particularly after last night's speech,
Yeah,
is that the labor costs are going to go up, and I'm not saying they shouldn't, because that's been out of line for a long time, 25 years. But what's happening is those two forces are pushing on those margins, and when those margins break down, you can't continue to say, okay, we're going to hold these multiples at this level. Those two things don't fit together. They go against opposite direction. And I think that people are sort of blind to the fact that this could happen, and they're really buying into this transitory quote. It'll go away in September, so don't worry about it. I'm not certain that's going to happen that way.
yeah. Particularly you mentioned a number of commodities that are going to see inflationary pressures for a prolonged period of time, precisely because of this massive push towards renewables, because of the demand for industrial commodities as well, and food prices, obviously. So, what do you think about the stimulus plan that has been announced, the 2 trillion infrastructure plan, and whether how that fits with the current environment of economic growth and jobs improvement?
Well, I think, Daniel, unfortunately for that 2 trillion, if you look at the percentage that's actually going into infrastructure, which is what we need, actually, we need infrastructure. We have highways all over the United States, and I've been everywhere in the US, and they all need work. The bridge, everything needs work. And yet, unfortunately, a low percentage of that is going where it should go.
Yeah.
It's typical of what we get out of Washington. And I think that will end up being the problem. They'll end up spending the money, but it won't be in something, at least during the jobs work under FDR, you built things and you had to go to work. Now people stay at home and we don't build anything. And so that's going to be a problem for us. But I think it won't be as effective as obviously as they think it will be.
Certainly. Obviously, the multiplier effects of stimulus packages have been extremely low in the last 20 years in particular. But I come back to your point, is that it's about 6 to 8% of the plan that is actually truly infrastructure, isn't it? What do you think the impact of the dramatic tax increase that the administration has announced. First, do you think it will pass? And second, do you think how do you think it will play in terms of both the equity markets and the economy itself?
Well, you have to think about it from the person that's making more than 400,000. And so there's some facets of that law. Now, I think they'll pass it. Let's say they do 40 and they end up at 36% on the long-term capital gain. That's still not very good. That's still bad compared to where we were. But I'll tell you the implications are this. When you step up, I'll give the two main drivers of investment really are real estate and really financial. And if you look at the stock side, for example, if I'm going to pay 36 to 40% gains on everything I take, when I can only write off $3,000 if I take a loss, that risk reward is not too great right now, no matter how long I hold it. And the second part of it is on the real estate side. If you take away 1031, which has been the greatest boom for real estate in this country, which is when you take those gains, you turn them into another piece of property, you don't pay tax, current tax on it. If you take those two things and then you move away from the step-up basis for your inheritors, for example, you've all of a sudden taken people in the top wealth group right there and you put them in a major shock. Yeah. And all of a sudden they're really having to rethink everything. I just talked to one this morning, Florida. They're not going to sell it. They have a full bid on a piece of property above what they would have normally taken. And they said, we're not going to take it because we're worried that they may come back in on us on see it. And so what it will do, it will keep people from doing things. Every time somebody sold a piece of property or sold a stock, they did something else with it. They either bought another one or they fixed up a building or they added people in the company. So what it does is it slows down business turn is what happens. And I think that'll be the ultimate end to it. It'll slow it down.
One of the things that has concerned me in the last years after the financial crisis is that in developed economies, we have seen a very poor improvement in productivity growth. But with this tax bill, what I see is that you're basically aiming at massively increasing the taxes on high productivity while increasing the subsidies on low productivity. And that was an absolute disaster in the Eurozone, which obviously has created very poor growth and very poor job creation in recovery, growth, or keeping them in recession times. No, do you think that when we're seeing that even in the estimates there's about 12% increase in GDP estimates from the IMF, 2021 to 2022 for the United States, yet unemployment remains relatively elevated compared with the levels where it was prior to the COVID-19 crisis? Do you think that is going to further put a brake on job creation?
If they keep coming with, let's say they come with another round of some sort of subsidy to people and they stay home, that's the problem we have today. I think I'm in touch with as many businesses as anybody. They all have the same problem. Yeah. They can't get anybody to drive a truck. They can't get anybody to work in a restaurant. They can't get anybody to do anything because right now they make plenty of money until at least September. And so if they want to extend that, no, we don't. We have the same problem over and over again, except that there's some point there that it stops. And then you have to decide, okay, what happens after that? My guess is that you don't have the boom stops. At least it slows down at that point.
Mm-hmm, mm-hmm. When you think about not 2021 with all of these different aspects of artificial stimulus that we're seeing, but 2022, what are the main areas that you're more optimistic and more concerned about?
Well, I'll be more optimistic still about the basic commodities, and I'm also optimistic about the companies that continue to grow. The common stock companies continue to grow. If they can grow at 15% in this atmosphere, they will do okay. There's not that many of them, but if they can do it, that's a positive look right there for them. The negative side is that I think with this mantra of Wall Street on the 60-40 portfolio this whole last 20 years, for example, that investors are going to have a hard time, because a lot of people in our industry don't understand this,
Yeah.
that when you turn the bond market on them the other way, then all of a sudden they have a problem. They don't know what to do. And I think the bigger problem for people, and maybe it comes and goes back and forth, but it's going to be the bond market for them over the next, the next 22 period.
Certainly. I mean, pension funds are going to have a
Right.
real problem, because it's not just real losses; it's nominal losses now. Huh? So
Well, property insurance companies, that finance a lot of real estate and that sort of thing, they're having, they can't get anything off the bonds now.
sure.
And you notice them, they're raising their prices to the end consumer, and they're going after real estate with these really low rates. I'm talking about 2.7, 3% for 10 years fixed, that kind of thing. That tells you that they're getting nothing out of the bond market.
Absolutely. One final question, because I'm conscious of your time. This divergence between very low financing rates for sovereigns, while the interest rates at which small businesses are financing themselves, how dangerous can it be, and at which point we start to see a rising non-performing loans in commercial banks?
Well, I own part of a bank myself, and so I'm involved in it and involved in looking at the borrowers, I should say. And what happens is, right now they're all in fairly decent shape, because most of the companies have come back. They've, between PPP and being liquefied, they're in fairly good shape. I think what happens is when you go a little bit further out and business picks up quite a bit, and they have to start taking on more employees and more debt. And if that happens to be right before you sort of tip the scales a little bit, that's where banks will miss it, because banks have been notorious about not seeing what could happen, because they really live in the moment at a time. Most of them do. And so we'll see what happens, but I think that's the way it'll go on it.
Well, it's been great talking to you. I think we could spend quite a lot more time, but I'm very, very conscious that you have a very, very busy agenda. It's been great to talk with you, and if it's okay, it would be fantastic to follow up in a month's time or so, and see your thoughts about the new developments in the economy and the stock markets. Thank you so much, Ted. Thanks for joining us.
Daniel, thank you too. Appreciate it.
And you have all the details about Ted and Oxbow advisors in the details of the video below. Thank you very much. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.